In the last video, I laid out a fundamental shift in the global economy. For decades, the world operated like a just in time factory, prioritizing maximum efficiency. Now, we're shifting to a just in case model that prioritizes security and reliability. That changes how the world prices everything. The market isn't waiting for consensus, it's already moving. This week offered a powerful example: the strategic US moves around Venezuelan oil. But this doesn't just confirm the thesis, it reveals the next global pattern. Two stories that most people see as unrelated are, in fact, the same story: a strategic pivot in the Caribbean oil market and a quiet race to control the Arctic. They appear to be the first moves in a global scramble for resources, and capital is already placing its bets. For years, Venezuela has been a story of collapse. It holds the world's largest proven oil reserves, yet its production crashed from over 3 million barrels a day to well under a million due to mismanagement and crippling US sanctions. This pushed its oil onto a shadow fleet of tankers and into a black market, sold at a discount, primarily to China. This created a parallel energy economy operating outside of Western control. The old game was containment. One interpretation is that the new game is about control. The incentives seem to be shifting from simply walling off Venezuela's oil to directing where that oil flows, who buys it, who ships it, and how the money is handled. It's about who controls the flow of that oil and, critically, the currency it's sold in. The dollar is the default operating system for global oil. For years, Venezuela tried to run a different OS, a direct challenge to the global financial system. A revival of its oil industry under Western influence would likely bolt its exports right back into the dollar system. And markets may already be pricing this in. Venezuelan government bonds have been rallying. This suggests that some market participants are betting that the country's assets are being revalued as they are brought back into a US-led financial sphere. This isn't just about oil. It's about capital anticipating a major strategic realignment. The mechanism here is direct. By bringing a major supplier back into the fold, the goal may be to stabilize prices, but the process of realignment itself introduces a new kind of political risk premium. The Arctic was long imagined as a frozen wasteland. That picture is dangerously out of date. As the ice melts, a new map is being revealed, holding three critical prizes: new shipping lanes, vast energy deposits, and a new arena for great power competition. The USGS estimates the Arctic holds a significant share of the world's undiscovered oil and gas. But today's competition is about more than just fossil fuels. Greenland, for instance, is thought to hold huge deposits of rare earth elements, essential for everything from advanced defense systems to EV batteries. This has not gone unnoticed. China, calling itself a near-Arctic state, is pursuing a polar Silk Road, investing to build its own toll roads in this new territory. Russia, with the world's largest icebreaker fleet, has been reinforcing its military and economic footprint along its northern coast, viewing the region as its strategic backyard. In response, Western states are visibly increasing their focus on the region. The US is bolstering its diplomatic and military presence, and NATO allies are following suit. The opening of the Northern Sea Route along Russia's coast and the Northwest Passage through Canada literally changes the map of world trade, potentially slashing travel time between Asia and Europe by up to 40% compared to the Suez Canal. Transit on these routes is growing, with recent years seeing millions of tons of cargo moving between Russia and China. The mechanism here is about future supply. The race to claim these resources and routes increases the long-term cost of capital for everyone, as nations spend heavily to secure assets that won't pay off for years. If the events in Venezuela and the Arctic are the cause, the reaction in commodity markets is the effect. This is where the thesis gets priced in. Let's start with gold. For years, textbooks said gold and real interest rates moved like a seesaw. When one went up, the other went down. That relationship appears to be broken. Central banks, especially in emerging markets, have been on a historic buying spree since 2022. One interpretation is that this isn't a short-term hedge, but a structural shift away from assets vulnerable to financial sanctions. Now look at copper. They call it Dr. Copper for its supposed ability to diagnose economic health. Lately, it's been telling a different story. Copper prices have remained surprisingly strong, even with signs of weak global growth. The market may be starting to price in a security premium. Copper is no longer just an industrial metal. It's a strategic one, but its supply is concentrated. The price now seems to reflect not just supply and demand, but also a premium for geopolitical risk. This pattern is emerging everywhere. Capital is flowing to real assets and the companies that control them. It's a hedge against a world where the free movement of goods can no longer be assumed. So let's tie this all together. The pivot on Venezuela, the competition in the Arctic, and the strange strength in gold and copper aren't separate stories. They are all evidence of the next global pattern. A shift from integrated, just-in-time supply chains to fractured, just-in-case resource blocks. We are leaving an era defined by economic efficiency and entering one that appears to be about geopolitical resilience. First, this pattern points to more instability. When essential resources become part of a zero-sum game, the risk of conflict rises. The choke points of global trade become potential flashpoints. Second, it will reshape markets. That security premium in copper could become a permanent feature. Capital will likely favor companies that control real things: mines, oil fields, shipping fleets. So what are the key indicators to watch? They may no longer be just earnings reports. Instead, watch for policy shifts justified by national security. Watch for the intensity of sanctions enforcement and spikes in shipping insurance rates. Track rising defense and industrial spending, and look for signs of national inventory rebuilding. And critically, monitor the premium for physically delivered commodities over their paper futures, the gap between the real thing and the promise. The race for resources is changing the architecture of the global system. The thesis is that smart money has already identified this shift and is beginning to move. The question for the rest of us is whether we've caught up. If you want to stay ahead of these global patterns and understand the forces reshaping our world before they hit the front page, make sure you subscribe and hit that notification bell. We're going to be tracking this new era of resource competition every step of the way. We've covered the scramble for resources in Venezuela and the Arctic. But the real leverage comes from controlling how they move. In video 3, we'll dive into the plumbing of global trade, the shadow fleets, the weaponization of insurance, and the choke points that define the new map of risk. We'll get into that in the next video.